In this video, I'm going to discuss the importance and power of multiple time frame trading. Multiple time frame trading just lets you look at your currency on multiple time frames. Here you can see I have the daily chart up, which has the 10, 20, 15, 200-day moving average, and our FX Momentum Pro, which kind of lets you see how much momentum the euro-dollar pairs had and all the dollar pairs had the previous day. There's not a whole lot of momentum. A lot of times when there is a momentum move, the next day is like very, very much likely to have continuation to the upside or downside. This was a 60-minute chart, which I don't have any indicators on, mainly because I use it to draw Fibonacci profit target levels. As you can see, Fibonacci profit targets of this were the areas where there was likely to be some resistance today, and of course there was. The 5-minute chart, you could substitute a 6 pip per bar range chart. And, so basically looking at this, you see that the euro dollar was in a downtrend. It's rallied up. You might also want to draw your fibs from the high here down to here. And you can see the 50% fib. Actually, let me redraw that, make sure it's perfect. 50% fib is at 34.31. So it's quite a bit a ways up. We have the 38% fib there at 32.41, which you can see right here on my chart. This is going to be a resistance area. If the price can stay above that, it's quite bullish. You also have Fibonacci profit target levels up there. So it's really kind of in an area that could continue up or run into resistance like you saw today. It's very dangerous to trade a currency that's stuck inside of multiple areas of support and resistance. You're better off, just like you are if you want to get to work fast, taking a road that allows you to drive fast as possible and doesn't have much traffic on it. If you've ever driven through Los Angeles during rush hour, you'll notice that you might move 1 mile in an hour's time frame, and it's very frustrating. And so is trading when you have multiple areas of support resistance. Now, starting the day off, we're stuck between the 10-day moving average and the previous week's high, and that's one of the reasons why the market's just kind of chopping around here. If you didn't know where these support resistance areas are, you might have taken some trades and either had small wins or small losses in there. If you had our software and had all the support resistance areas that are key on your chart, you really wouldn't have taken any trades until it broke out right here. Most of the time when a price does have very tight, low volatility like this for many hours, when it does break out, you're likely to get at least a 2-wave move up. So basically you could get into this trade when it broke out right here at 32.10, and there's major resistance, the upper containment band right here. You might want to exit half your trade, or as you can see here, when the trailing stop got hit out of the whole thing. And you can give it a shot right here by, when it goes sideways into a little wedge pattern, of buying this breakout here as well. And you have your Fibonacci profit target of that previous wave up to draw, and it gives you your first and second fib target. We have the previous day's high right here, which is a resistance area. It's above our upper containment bands. And let me add the 3.0 containment band on here, because 95% of the time that contains price, and you can very safely and successfully sell the 3.0 band, which I like to color green on my chart so I don't miss it. So you can see that's exactly where the 3.0 band was. So I would have taken this trade, got out at the 1.382 fib target, 32.75, this last trade right here. You can see it was about a 30 pip win. And you don't necessarily want to go short right there, although you might have. If let's say you did go short right here, you have a very, very tiny, it's kind of going sideways. You really want to wait for price to go underneath there, and it didn't. It comes up, the previous day's high, has a false breakout. It's also another Fibonacci profit target I did last night, and it's above the 3.0 band. So when it starts to come back down, you might want to go short at 77 and use our trailing stop to get you out at 55. It's a 22 pip win. You only need 10 pips per day to double your account every 2 months. Let me just quickly show that. I show this a lot in our Forex blogs, but it's very key to know that. 10 pips per day. Let's just start with a $2,000 account. That seems to be the average that people are setting up new accounts with. Every 8 weeks or 2 months, your account pretty much doubles. You can see it doesn't take very long to have a decent sized account. Now you're trading 7.7 lots at a time. Obviously, it gets to a point where you're trading a tremendous number of lots, and the account at the end of the year is about 130 times bigger than it was starting. That's the power of compounding. So keep that in mind when you see a lot of traders think, oh, I need 30 to 50 pips a day. No, you don't. You need 10 pips a day. So you're short here at 79 and you made 22 pips on this trade. That's 2 days worth of minimum net profit. One of our trading systems is the Elliott two-wave system. Anytime you see a strong move up followed by a pullback without that much weakness, it's very likely at the next profit target levels to find support. And you can see it came down here as it's going sideways. There's not a whole lot of statistical momentum. The daily trend's up, the weekly trend's up. The monthly trend's down. I pretty much ignore the monthly trend. So you might have bought this when it broke out here at 34. And always keep in mind where the fib targets are of the last wave. This went right to the 50% level, kind of went sideways, ran out of steam. Good place to exit half, and then the other half when the trailing stop got hit. So you would have been out at half at 45, half maybe at 57. Your average exit maybe is 54. You're in this trade at 36, and you made 17, 18 pips. You never know really what's going to happen after you get a two-wave pullback and then it only goes up 50%. It could stall here and come back down. If it breaks this low, then it's likely to continue further down. If it comes back down and it can't break the previous low and it chops around here sideways for a while, you might want to give it another shot to the upside. Remember, above the hourly, it's more likely to go up. You buy it again right here. This is the last trade that I see on here I would have taken. In at 52, and it comes right back up to the previous day's high. And there's only one bar with incredible momentum. And as it's going sideways right here, it kind of loses it. So more than likely, because I usually believe the previous swing high is going to be where it stalls, I would have just got out of this trade right here at around 75. In at 53, 22 pip win, and that would have been done. It's Friday today. Usually after 11 or 12 on Friday is pretty dead.